Good morning. Can y'all hear me okay? Good morning.
Good morning.
Okay, good. How are you doing this morning? Oh, I can't believe final exams next week. I'll be right back. Morning, how are y'all doing? Oh, I can't believe I told my husband last night, I said, tomorrow's the last Tuesday of teaching before final exam, but y'all be ready. Taylor, you sleepyhead this morning?
Always.
Oh. Okay, let's see. Let me get my act together here. For those of you that are in here, well, maybe it's all of us, go into, in course content information, there's a chapter 11 notes page where I describe the steps for calculating, doing disposals, whether you sell it, retire it, or exchange it. So we'll be referring to that note today. One of the things that, good morning, welcome to the last week of online class. One of the first things that is covered in the chapter is depreciation. I assume that I'm going to go over the concepts and the parts about depreciation that you must take into consideration. I don't want to spend a whole lot of time calculating the depreciation because the two methods that you're going to use are straight line and units of activity. Those are the only two depreciation methods that you will be tested on. The sum of the year's digits and then that accelerated method, which is the declining balance method. We call it DDB, double declining balance. You will not be tested on. So as I said last week, it'll just be straight line and units of activity. The calculations on them are fairly, or not fairly simple, are simple. So what I would like to do is I'm going to go into a Word page and I'll just type out notes that are important for depreciation. And then we're going to get into the dispositions of how do we sell it? How do we retire it? How do we exchange it? We'll refer to the course content information that I have uploaded in Blackboard and course content information, and we'll go through the example that I have there also. You can see that there are 3 files. One is a notes page, one is the example of how to do it, and then if the calculations themselves, how to apply it. And then the third one is the Excel sheet that shows how I calculated the numbers that are in the journal entries, okay? So we'll go through that problem, and then we're going to learn about the concepts of this revaluation that companies that are using IFRS, where we see this huge difference with respect to long-term assets between US GAAP and IFRS. We're also going to take a look at impairments, and we're going to take a look at how do I handle a change in estimate and actually the calculations of that change in the estimate. Okay, so that will get us through chapter 11, and I'm hoping we'll cover enough today where we can spend just half a class on Thursday addressing any questions that you have about chapter 11, and then spend time reviewing for the exam. Over the weekend, I uploaded the, did you see where I uploaded, I think it's Colby. I think Colby was buying, I don't remember what he was buying, for interest capitalization. So I made up that problem. I think I did it on Friday or Saturday. Did that problem, and I have the solution up. Of course, work the problem without referring to the solution to see how well you're doing with your interest capitalization. I also uploaded the topical index, the topical coverage for the final exam, so that you can go through it. One of the things that I am doing is, I'm used to giving paper exams, and obviously I word process those myself. Because we're in online, it's very difficult to write your own exam. I don't know if you've ever heard other professors talking about online and putting in your own, you can insert questions, but doing your whole exam online is just very time consuming to do. So what I am doing is I've started preparing the exam now. I spent 5 hours yesterday. It's crazy. 5 hours yesterday just doing one chapter, chapter 8's questions that I want to, include in there. It just takes a long time to get the exam you want. But the reason that I wanted to prepare the exam now is because the online questions can be different than the way that I would question. So I want to make sure going through every single question that could possibly appear on the exam, I'm looking at every single one of them to make sure that we have the coverage and that you've been exposed to how to calculate it the way that you see it online, as you see the Connect. Am I making sense on that? Okay, so I want to make sure that on Thursday when we're going over that the exam is prepared. I know what's on the exam and I know how they are being asked so I can prepare you for that. All right, so let's go ahead. Any questions? How are y'all doing? AS2 is due on Thursday. Does anybody have any questions? Do I need to set up an open hour, office hours just on AS2? Okay, I think it was pretty easy to figure out. I will be setting up office hours the day before your exam, where I'm just going to have open office hours for several hours, and you can come in and go like I did before. So the day before your exam, I'm going to have open office hours for you. All right, I think that's a lot of the house cleaning, administrative stuff that we need to do. Also, please don't forget to send me your participation in the faculty because I've got an Excel sheet where I'm keeping track of, who did answer it as part of that participation extra credit that I'm going to be doing. The extra credit you won't see in your grade book because it'll be something I have to do after I have downloaded the grades from Blackboard because of that weighted average. If I add a column to it, I have to include it as a weighted average. It just, but just trust me that you will be getting that extra credit. It's not just lip service, and that I will add it on there. By no later than May 10th, I am going to put on Blackboard what your final letter grade is so that one, you can question about the extra credit if you think that there's a disconnect between what you earned and the letter grade that you have. So it gives you an opportunity to ask about your final grade. Plus, it gives you the time to determine whether you want to go SU or the letter grade. Okay. All right. So I'm going to quickly go through the concepts, the important things to remember about depreciation, more than getting into the calculation of it. So I'm going to pull up a Word doc and I will be sharing the Word doc with you. And then you can take a picture of the Word doc as your note taking. All right, so do you have a blank Word doc? Is it sharing okay? All right, with respect to cost allocation. Now, I'm not going to write this part down, but what do we call cost allocation for depreciation? I just told you. What do we call cost allocation for tangible assets?
Depreciation.
Good, depreciation. This is our last Tuesday. Let's everybody show faces and get busy and wake up. Depreciation. What do we call the cost allocation for natural resources?
Depletion.
depletion and for definite life intangible assets?
Amortization.
Good, amortization. Okay, so cost allocation is exactly what it says. It is allocating the cost of a long-term asset over its useful life. And the useful life is the length of time that the long-term asset will produce revenue. Okay, so we've got a long-term asset. Say I paid $1 million for a piece of equipment that's going to last 10 years. Would it make any sense at all that I would have $1 million expense in the year that I bought it when it's going to be producing revenue over 10 years? Would that make any sense at all that that $1 million of expense would be on the income statement in the year that we purchased the asset?
No.
No. Okay, because we want to allocate its, the capitalized cost less the residual value over its useful life. So it is very important to remember that this is a cost allocation. Cost allocation has nothing to do with fair value of the long-term asset, right? Nothing whatsoever. It is simply a cost allocation. It is not trying to reflect what the fair value of the long-term asset is. Okay. So we've got cost allocation, and what is the amount that will be allocated over the long-term asset's useful life? What do we call it? What do we call the amount? Don't tell me how we calculate it, but what do we call the amount that would be allocated over the long-term asset's useful life? Come on into the semester. Go ahead. I'm sorry, Liam.
Service.
You were cutting out a herd service. What about allocation base? So the amount and that may have been what you said, Liam. I just heard service. So the amount that is allocated over the long-term asset's useful life is called its allocation base, which is on page 573. And the allocation base is calculated the allocation base is equal to the capitalized so it's equal to the capital, what is wrong? Capitalized cost minus the residual value. Okay, so your allocation base is equal to your capitalized cost minus your residual value. If I paid $100,000 for an asset and I anticipate that at the end of the life of the asset, that I will be able to sell it for, what did I say the capitalized cost was? Say I spent $100,000 on a piece of equipment. So the capitalized cost, whoa, what happened here? Where'd it go? There it is. So that the capitalized cost is 100,000. Well, if I anticipate that at the end of its useful life, I could sell it or exchange it for $10,000, then what is the ultimate cost to the company? They spent $100,000 on it. They anticipate that at the end of its useful life, that they could sell it or exchange it for $10,000. What is the ultimate cost of the asset to the company?
90,000.
Good, Ashley, 90,000. So that is the amount. That's the allocation base. The depreciable cost, if it's a long-term, if it's a tangible long-term asset. You can see at the very last paragraph on page 573 that the allocation base is called the depreciable base for a tangible asset, the amortizable base for definite life intangible, and the depletable base for a natural resource. Okay, so the depreciable base for a tangible asset is the capitalized cost minus that residual value, the ultimate cost that's going to be allocated over the time period that I am generating revenue. Now, some very important concepts about the allocation base. One is we can never depreciate more than the allocation base of a long-term asset. In other words, the book value cannot be lower than the residual value. Okay? So we can never depreciate more than the allocation base of a long-term asset. We're going to see in units of activity that if I estimated that I have a truck and say that I estimated that the truck would last 100,000 miles. Well, what if the truck lasted 110,000 miles? You're going to see that in that last year where it reached up to the 110,000 miles, which is more than what I had originally estimated it would last, you know, the units of activity, then in that last year of depreciation, I will not be able to take all of the depreciation because the total accumulated depreciation related to that asset cannot be higher than the allocation base or the depreciable base. Okay. So that is the allocation base. Now notice that I said that the book value cannot be lower than the residual value. How do we define book value? These are all important concepts or terminology that we're going to be using today as we are practicing and applying problems. So what is book value? Ryan, what's book value? Jackie, what's book value? Jackie,
Isn't it what it's worth, like, on your books? So is it what you paid for it?
right. So be careful with the word worth. That when we think of worth, we think of fair value. Remember, depreciation, so accumulated depreciation, has nothing to do with the fair value of an asset, okay? It simply is a cost allocation. So the book value is, what would be my formula for book value? The amount that it's reported in the general ledger or on the balance sheet at.
This is a cost minus accumulated depreciation.
Nice job, Tanisha. So it is cost, which we know is capitalized cost, cost minus accumulated depreciation is your book value. This is the amount that is reported on the balance sheet. Think of your balance sheet where we listed the cost, and then we have less accumulated depreciation, and the net of those two numbers is what's sitting under property, plant, and equipment in my balance sheet category of property, plant, and equipment. So that is the amount that is reported on the balance sheet. The other thing that we have to remember with respect to depreciation is that in the year of acquisition and in the year of disposition, you will have partial year depreciation. You will have partial year depreciation. If I purchased an asset on April 1st, so that's the year of acquisition, I purchased an asset April 1st. How many months of depreciation would I take that first year? Come on, where's our,
9, you said April.
right, so good, 9 months. I purchased it April 1st. So I used it for 9 months. I misspelled partial. So in the year of acquisition, you will calculate depreciation for the portion of the year that the asset was used, which would be from the date of acquisition to the end of the year. We also calculate partial year depreciation in the year of disposition. So in the year of disposition, that's the year you sold it, the year you exchanged it, the year you retired it, you will have partial year depreciation for the portion of the year that the asset was used, which would be from the beginning of the year to the date of disposal. So if I disposed of an asset on April 1st, how many months of depreciation would I take in the year of disposition? I sold it on April 1st. How many months of depreciation would I take?
3.
Y'all are killing me. This is easy, and I might ask that y'all all put your videos on, and let's start acting like a class that's in their last week before finals. Come on, how many months? I heard Catone had it, but I think Catone's been, and Nicole answered, and Tanisha answered. So let's, good, 3, okay? Because we sold it on April 1st, so we would have used it January, February, and March. So we would take 3 months of depreciation. I assume that you know how to calculate straight line depreciation. What is the formula? What is my numerator?
Cost minus residual value.
Good. Cost minus residual value of Taylor, what equals what? Oh, I said case. This is
The allocation base.
exactly. So your numerator is your allocation base, cost minus residual value. And what is your denominator?
Estimated life.
Good, your estimated life. How long do I expect to be using the asset? Okay. Now and then you can do that. There's problems at the end of the chapter where you can calculate depreciation. Now, what is the formula for activity-based? Activity-based is on page 577.
Depreciable base over the number of units expected to be produced.
Okay, good. Was that Ashley?
Nicole.
Nicole, sorry. Yes, so again, your numerator is your allocation base, and the denominator is how many units do I expect this asset to produce? Okay, we need to be careful with units of activity to make sure that we don't depreciate more than the allocation base. I gave you the example of what if we estimated 100,000 units would be produced, but it ended up being 110,000. We would have to make sure that in that last year of depreciation that we did not take the full amount of the depreciation. Look on page 578. Look on page 578. And on 578, again, I know it's the last week and I'm still begging y'all to critically read the accounting textbook. And that when you looked at illustration 1130, did you calculate how did they come up with that 24,000? How did they come up with the 24,000? Did anybody? Oh, move out the way. Did anybody figure it out?
Isn't it because it's they need the end of the year book value to be the 40,000, and in order to get that, it's like
Good. And what is the 40,000?
the expected residual value.
Good. The 40,000 is the residual value. So the book value cannot be below the residual value. In other words, accumulated depreciation cannot be more than the allocation base. The allocation base is 210,000. Right? They had purchased 250,000 for the asset. They expected that the residual value would be 40,000. So the depreciable base was 210,000. Well, they ended up producing more than 140,000 units. So the only amount of depreciation that they could take in year 5 was 24,000 because of that rule that we cannot depreciate more than the allocation base. In other words, the book value cannot be lower than the residual value. Okay? Okay, so I'm going to quit sharing the screen, and you can see on page 581 where they talked about partial year depreciation. Here, I'm back, where they talked about partial year depreciation. One of the things that get your sleepy heads awake and just logically think about, I said that there's partial year depreciation in the year of acquisition and in the year of disposition. Now, the denominator for straight line is a function of time. So we're going to have partial year depreciation for straight line. Now, the units of activity is when we take the depreciable base, right, my allocation base, and divide it by the number of units that I expect to be able to produce, what do we end up with? What is that quotient? So looking at the page 577, the one that we just looked at, where they had an asset of 250,000, it had a $40,000 depreciable base, and we expected to get to produce 140,000 units. So when they divided the depreciable base by the number of units, what did we end up with? What was the quotient? Oh my gosh, y'all are disappointing me.
The amount per unit?
Good, we get, pardon me,
AFIA.
as I say, it was a FIA.
The amount per unit?
Good, we get the
Dollar.
amount per unit. I
Yes.
understood that Caribbean accent. I got it. All right, so it gives you the cost per unit. That gives you your cost per unit. And then you multiply it by the actual number of units used. The actual number of units used to get depreciation for the year. Would I then multiply it? Say that they purchased this asset on April 1st. I'll keep using April 1st. So they purchased this asset on April 1st. And the first year, when you look on page 578, on the first year, they produced 20,000 units. They produced 20,000 units. So 20,000 times the $1.50, which was my per unit cost, gives me depreciation for the first year of 30,000. Why didn't they multiply it by time? If we purchased it on April 1st, why didn't they multiply it by 9/12?
Because the depreciation rate is based on units.
Very good. The depreciation base, thank you, Jacqueline. The depreciation base is what is my cost per unit? Well, if I had purchased this asset, instead of purchasing it April 1st, if I had purchased it December 1st, then the number of units produced would be far less than the 20,000 units that I produced. So time is already included in that concept because it's based on the number of units produced. If I purchased it April 1st, I could produce more units than if I had purchased it December 1st. Okay, so don't multiply it by time when you're using units of production, because time is already taken into consideration when you buy the number of units produced. All right, the next concept, before we get into disposals, the next concept that I want to talk about is change in estimate. Before we get into the disposals, change in estimate on page 596. A change in estimate, we learned way back in chapter 4, is handled prospectively. Meaning that when I've got a change in an estimate, say that I'm in the middle of using this asset. I originally estimated that it was going to last 10 years. Now I see it's doing great and it's going to actually last 14 years. That's a change in an estimate. Since we handle it prospectively, you recalculate the depreciation under the new assumptions, and then go forward. Let's look at exercise. It's either 1111 or 1122. Must be 1122. Nope, neither one of those. Why did I have those in my, 22 is a revaluation. Let's look at 1123. Exercise 1123 on page 625. Now, I'm going to share an Excel file. I know I've just been moving on and y'all have been quiet. Any particular reason why? Or did y'all read chapter 11? Or did you just use SmartBook? Come on, own it so I know. I'm not going to fuss at you, but so I know how in depth I need to go, because so just be honest and I'm not going to be upset. How many of you just use SmartBook for your reading? So everybody read the chapter completely?
Yes.
Okay, cool. All right, so on exercise 1123, I'm going to go in. Thank you, Liam. Good. So I'm going to share screen. And do you see an Excel file?
Yes.
Yay. And of course, I will make it bigger for y'all to see. All right, so let's take a look at exercise 1123. We've got a company that purchased a mini computer on January 1st. How convenient, it's January 1st, but that's okay. And we had a cost of $40,000, a cost of $40,000. And the computer was depreciated using straight line, and my useful life was 5 years. My useful life was 5 years, and my residual value was 4,000. Whoa. So my residual value was 4,000. Now on January 1st, again, how convenient that they're both January 1st, the estimate, the useful life estimate was changed to 10 years, and the residual value was also changed. So on January 1st, of which year? 2021? Well, I don't know. Of course, my cost is going to stay the same, and they estimated that the useful life would increase to 10 years. But of course, if I'm going to use it longer, the residual value would decrease, and they decreased the residual value to 9 years. So what we need to do when we have a change in estimate is calculate step 1. Calculate the book, Lisa, the book value as of the date of change. So calculate the book value as of the date of change. What happened here? So the book value as of the date of change, since this was January 1st, we purchased it on January 1st of 2019. So what was my depreciation for January 1st of 2019? What would be my annual depreciation under the assumptions? What would be my annual depreciation?
7,200.
7,200. Let's see. My numerator is the 40,000 minus the residual value. And then I would divide that by the useful life. So the annual depreciation is 7,200. Now, again, we purchased it on January 1st. So what is my depreciation for December 31st, 2019, and December 31st, 2020. It would be the full 7,200 since we purchased it on January 1st. So we would take $7,200 of depreciation in 2019, and we would take $7,200 of depreciation in 2020. Now, when did they change the estimate?
January 1st, 2021.
Good, January 1st, 2021. So what is the book value as of January 1st, 2021? The book value as of the date of change.
Is it the cost minus the depreciation from 2019 and 2020?
Perfect. So my cost is 40,000. And what is my accumulated depreciation as of December 31st, 2020?
14,400.
Good. So it's equal to my depreciation from 2019 and 2020. So my book value, oh, what is wrong with my typing today? My book value as of January 1st, 2021 all right, is equal to cost minus accumulated depreciation and is 25,600 is your book value as of January 1st, 2021. Please stop me if you're not understanding the calculation. So step one, calculate the book value as of the date of change. 25,000. Yes, ma'am. Question?
I just coughed.
Oh, sorry. So now we need to calculate the depreciation going forward. Change in estimates are handled prospectively going forward. So recalculate the depreciation under the new assumptions. My numerator is going to be the book value as of the date of change. So my numerator is the book value as of the date of change minus what?
The residual value.
Good.
The new one.
And which residual value? The old one or the new one?
The new one.
Good, the new one, the 900. Okay, so remember your numerator was cost minus residual value. Now, when we have a change in estimate, it's going to be book value minus my new residual value. Now, my denominator is going to be the remaining life of the asset. Now, what is the new useful life?
10 years.
10 years. How many had we depreciated? Now, let's be very careful with wording here. It said the estimated useful life was changed to 10 years. It didn't say that the remaining useful life is 10 years. So be careful about that. It's saying that the useful life, the total useful life is 10 years. How many years have we depreciated?
2.
2. So what is the remaining useful life of the asset?
8.
8 years. So what is my new annual depreciation?
$3,087.50.
3,087.50. Perfect. Okay. So did everybody understand what we did? You have to calculate when there is a change in an estimate. You must calculate the book value as of the date of change. You must calculate the book value as of the date of change, and then calculate depreciation under the new numbers. Okay. There are other practice problems for a change in estimates. Several of them change in the depreciation method. This one was change in useful life and the residual value. So make sure that you take a look at those on your estimated useful for change in an estimate. So this was exercise 1123. All right, are we comfortable with a change in an estimate? All right, I'm going to send out a polling question. And let's see what our polling questions are. Here we go. Let me launch this one. While y'all are doing that, I'm gonna freshen my water. All right. So the asset's initial capitalized cost minus the residual value. Good. Okay. So nice job on that. Let me look at another polling question to see if there is oh, stop sharing. All right, here's one that's a change in estimate. Now, I'm going to have to, remember I told you I have very limited space. So I'm going to bring up can y'all see both the poll and the question number 77? Can y'all see both?
Not the question.
No.
Okay, you can't see the question. All right. I'm going to, in the poll, I'll relaunch it. Let me share my screen, see if I can pull them both up at the same time. And now let me see if I can. All right, now can you see both?
Yes.
Oh, perfect. Yay. Technology, this is so cool. All right, you can see it was too long. So here's one where you're calculating the
I lost polling question. I just see on my screen.
pardon me, you can't see the screen?
I can't see polling question. I just see screen. Where is my polling question?
So you don't see the question, you just see the polling?
I don't see the polling. I just see the question.
Okay, does anybody else see this polling over here?
I can see both.
Okay.
Yeah, I can see both.
Ms. Pham, do you see it now?
No, I don't know where is my polling question.
Okay, well, go ahead, and since you see the question, you see what the amounts are. So go ahead and answer it, and then send your answer to me in a chat. Okay, Ms. Pham, the rest will answer on the polling question.
I see the polling. It has a polls here.
Okay, so you found it?
Yeah.
Okay, cool. I'm working this one myself. I have it. Yeah. Give you another 45 seconds. All right, you've got 10 seconds left. All right, 5, 4, 3. Okay, I'm gonna go ahead and end the poll. And the majority of you answered the question properly. I got 126,000. Oh, good. I forgot the answer down here. So the answer is B. So 126,000. So let's calculate it. Oh, let me bring the problem back up. So we had 450,000 was the cost of the machine. What was the depreciable base? What was the depreciable base?
450,000.
Okay, good. If y'all don't get more active on going on this, we're never going to finish. And I know this stuff, and so I can quickly wrap it up if y'all know it so well that we don't need to participate in class. Okay. So what was our depreciable base? I think that was Nicole or Taylor.
450,000.
Good, 450,000 because there was no residual value. So what was the depreciation in the first year?
36,000.
Good, 36,000. And how did you calculate that?
I take the cost divide for the expected capacity and multiply with the units of products, 24,000.
Nice job. So you did the 450,000 divided by the 300,000, which gave you, I think that was $1.50 per unit.
1.5.
Well, yeah, 1.5 would be the amount per unit. How many units did they produce during 2021?
24,000.
24,000. So the $1.50 times the 24,000 gives you depreciation of 36,000. Now, when did they purchase this asset? When did they purchase this asset?
June 30th,
June
2021.
30th. Why don't I have to take into consideration the partial year depreciation in 2021?
Because it's built into the number of units that are produced.
Good, Katone, because it's built in the number of units produced. If I had had it for the whole year, I would have produced more than 24,000 units. Okay, so we know then what is at the beginning of 2022, so we only depreciated it 1 year. The engineers had a change in the expected capacity. So what was the book value as of the date of change?
414,000.
Nice job, 414,000. And what is the new denominator?
230,000.
Good, 230,000. So what is my cost per unit?
1.8.
1.8. How many units did I produce during 2022?
How did we get the 414?
The 414 was, Tanisha, what depreciation did you calculate for 2021?
Repeat the question.
What was your depreciation expense for the year 2021?
36,000.
Good, 36,000. So what is the new book value as of the date of change? What is my cost?
It's just
The 450,000?
yeah, the 414. Yeah,
No, the cost is 450,000,
I
right?
think the new cost will be 414,000.
Okay, not the new cost. Be
Oh.
careful about the wording. Not the new cost, the new book value. The cost is going to still be 450,000. But because I have 36,000 in my accumulated depreciation number, my accumulated depreciation balance at January 1st of 2022 is 36,000. Because at December 31st, 2021, I debited depreciation expense and credited accumulated depreciation. So the balance in my accumulated depreciation as of the date of change was 36,000. So if the cost was 450,000, accumulated depreciation was 36,000, then what is the book value as of the date of change? Tanisha?
The 414,
Good, the 414.
14,000. Yeah.
Right. So that is the new book value. That is the book value as of the date of change. So now that book value is going to be your numerator divided by the new estimate of 230,000 to come up with your new cost per unit. Okay? So does everybody understand where the 126,000 came from? And if you want to take a picture of the problem, go for it. All right, so let's go now to disposals. How do we handle when we dispose of an asset? Pull up in course content information. I uploaded a notes page. I uploaded a notes page that explains how to account for the disposal of long-term assets. Okay. And at the, on page two, at the very bottom, there are 4 steps. There are 4 steps at the very bottom of the 2-page document. Okay. Now the diamonds that I have explain information. It redescribes book value and describes when we calculate a gain and when we calculate a loss. If you remember these 4 steps in calculating the disposal of an asset, you will stay out of trouble. These 4 steps are not in the textbook. One is calculate the depreciation up to the date of sale. Does everybody see the course content, the note page? So calculate depreciation up to the date of sale. Remember, we've already talked about that we're going to have partial year depreciation in the year of disposition. Companies are going to have calculated depreciation as of December 31st of the prior year. Okay. So if I sold the asset on September 1st, how many months did I use the asset during the year of disposition? I sold it on September 1st. how many months would I have used it in the year of disposition?
8.
8. So we would need to depreciate it for 8 years. So your first journal entry ought to be debit depreciation expense, credit accumulated depreciation, recording the depreciation up to the date of sale. The second step is calculate book value. You've already learned what book value is. What is it?
The capitalized cost minus the residual value.
Good. Capitalized cost minus the residual value. Capitalized cost minus the, no. What is book value?
Cost
That's the
minus
depreciable
accumulated
base.
depreciation.
That's the depreciable base, right? Book
Cost
value.
minus accumulated
Didn't sound
depreciation.
right.
Pardon me?
Cost minus accumulated depreciation.
Exactly. Cost minus accumulated depreciation. Cost minus accumulated depreciation is the book value. So now calculate the book value. Number 3 is determine the gain or loss. And you'll read earlier in one of the diamonds on here that the gain or loss is compare the selling price to the book value. And compare the selling price to the book value. Let me get on the blackboard. And that I've got the selling price minus the book value. And that will equal my gain or my loss. Can everybody see this okay? So the selling price minus my book value is my gain or loss. If the selling price is higher than the book value, I have a gain. If the selling price is lower than the book value, then you have a loss. Then you have a loss. Okay? Then step 4 is do the journal entry. Do the journal entry. When you do the journal entry, you want to record everything you got. Right? We need to record everything that I got. If I sold it, I got cash. If I exchanged it, I got a new asset. Okay? So you need to record everything you got. Then you need to take off of the general ledger the asset that you sold. You need to take off the general ledger the asset that you sold. It's gone. So you're going to have to credit the asset itself and debit accumulated depreciation. Remember, the book value is cost minus accumulated depreciation. Cost minus accumulated depreciation. So there are 2 accounts in the general ledger that this piece of, say it's a piece of equipment, that this piece of equipment is affecting. The capitalized cost is in the equipment account itself. So I'm going to have to credit the equipment account. The amount of depreciation that I've taken to date on the equipment is sitting in accumulated depreciation. What kind of an account is accumulated depreciation?
Contra asset.
Contra asset. Okay, thank you, Daniel. A contra asset. So cost minus accumulated depreciation gives me my book value. So if I want to get the accumulated depreciation that I have taken, the depreciation that I have taken to date on this piece of equipment, which is now sitting in accumulated depreciation, I need to get rid of it. I need to get it off the general ledger because I've sold this asset. So am I going to debit it or credit it to get it out of the general ledger? Daniel, what kind of an account was it?
Contra asset.
Contra asset. What kind of a balance does a contra asset have?
The credit.
Credit.
Credit. Good. So if I want to get it to zero, what do I
Okay.
need to do to it?
Debit.
Debit. Okay, debit. So let's go through the examples that I have. I am going to pull it up. I think it was in chapter notes. Yep. All right, I'm going to bring up two. All right, now I'm going to share screen with you. All right, and I'm going to be going back and forth between this sheet and the Excel sheet that shows how these numbers were calculated. Okay, so on May 1st, Bostic Inc. purchased a sale law for $750,000. She estimated that the useful life of the asset was 20 years and that it had a residual value of $200,000. Straight line depreciation is used. So let's take a look at the first type of disposal. We sell the asset. When we sell the asset, we expect to get cash. And on November 1st, 2020, Bostic sold the loft for $630,000. So the first thing that we need to do is step one, bring depreciation up to the date of the sale. Well, what year did I sell it? 2020. So when was the last time that this asset was depreciated? Good, December 31st, 2019. December 31st, 2019. So how many months in 2020 did I use the asset? 10 months. So see, go ahead and get in your calculators. How did I get the 22, 9, 16, 67? We're going to be applying a number of concepts here with disposal of the asset. So go ahead and calculate how many months of depreciation do I need to take?
10.
10, good. So make sure that you understand how I got the 22, 9, 16, 67. So what was the depreciable base? What was the depreciable base?
550,000.
Good, 550,000. And what was the useful life?
20 years.
20 years. So how much is depreciation per year?
$27,500.
Good, 27,500. But how many months did I have in my year of acquisition?
10.
10.
Okay.
So did everybody get the 22, 9, 16, 67? If you didn't, raise your hands.
Muchas.
So what was my annual depreciation?
27,500.
Good, so 27,500 divided by 12, because there are 12 months in a year, and then multiply it by 10, because that was the number of months that that asset was used. So everybody should have gotten the 22, 9, 16, 67 debit depreciation expense and credit accumulated depreciation. So now what is step number 2?
Calculate book value.
Good, calculate book value. So can you see my Excel file now, or did it? Yeah, see, I have to stop sharing every time. And now can you see it? All right. So calculate the book value. So calculating book value, which I did right here, we know is cost minus accumulated depreciation. So when did I purchase the asset?
Well, it was in, I mean, it was in May, right?
2017.
Right, it was in 2017, but what day in 2017?
May 1st.
May.
So I purchased it May 1st. So how many months of depreciation? Remember, in the year of acquisition and in the year of disposition, you're going to have partial year depreciation. So how many months of depreciation did we have in 2017?
8 months.
Right, 8 months, because if I purchased it May 1st, then I had it May, June, July, August, September, October, November, December. So my annual depreciation, as we had previously calculated, was 27,500. And then 27,500 divided by 12 multiplied by 8 is the 18,333.33. And then we had the full year of depreciation in 2018, a full year of depreciation in 2019, and then we had already calculated the partial year depreciation that I had in 2020. This was the amount, the 22, 9, 16, 67 that I had to do that journal entry for. So what is the balance of my accumulated depreciation as of the date of sale?
$96,250.
Good, 96,250. The partial year depreciation, the 8 months of depreciation that we had in 2017, the full years in 2018 and 2019, and then the partial year depreciation that we had in the year that we sold it. So my accumulated depreciation has a balance of 96,250. My cost was 750. So my book value is 653,750. So what is step number 3? Now we've calculated the book value. What is step number 3?
To determine the gain or loss.
Good, to determine the gain or the loss. Now, the gain or loss is I compare selling price to what number?
The book value.
Good, the book value. So selling price minus the book value. What was my selling price? What did Bostic sell her sale off for?
630,000.
630,000. What was the book value?
653.
Good, the 653, 750 that we had just calculated. So is there a gain or a loss on the sale of this asset?
There's a loss.
There's a loss of 23,250. So now let's take a look at the journal entry. Let's Well, where is my, so let's take a look at the journal entry and that record what you got. They got cash of 630,000. Then get off of the books the asset that you sold. So the asset had a cost of a capitalized cost of 750,000. So I'm going to credit the building 750,000.
I don't think we're seeing what you're seeing.
Oh, I'm sorry. Thank you. I forget that in between I've got to. Is that better? Can you see it now?
Yeah. Yeah.
So we've got the cash of 630,000 that we received. We're going to credit the building for 750,000, the cost. And then we debit accumulated depreciation for the balance in the accumulated depreciation, the 96,250. And then we debit the loss that we just calculated of 23,750. If this had been a gain, what would I do? Debit or credit? Credit. We credit gains because gains are like revenues, right? To increase, we credit. But in this case, we had a loss and my journal entry should balance now. Now let's take a look at what would happen if I exchanged the loft. Now we're going to get into the discussion of the characteristics and accounting of with commercial substance and without commercial substance shortly. Okay. So on November 1st, the same date, November 1st, Bostic, instead of selling the loft, exchanged the loft. That she found another building in a better location. And so she decided to contact that owner of that loft. And they said, sure, we don't mind having your location. Can y'all see it? So do y'all see the Word document?
Yes.
Okay,
Yes.
so extension of the loft. So on November 1st, Bostic exchanged the loft. The fair value of her loft was 630,000, and the fair value of the new building is 730,000. Well, we know step number 1, calculate depreciation up to the date of sale. The same number, right? The 8 months of depreciation that we need to take, and then record the exchange. Now, what did I get? I gave up one building and got what?
A different building.
A different building. And that different building had a fair value of how much?
700,000.
700,000. So what did I get? I got a new building, fair value 700,000. What did I get rid of? My old building. And my old building had a cost of 750,000. See here, I could put in parentheses so that you don't get confused. New, old. So we credit 750,000 to get the old building off of the general ledger, and we debit accumulated depreciation for the balance that we had calculated in accumulated depreciation of 26,750. Let's go to that Excel file that I have. I have to stop sharing. We'll get back to the and on the exchange of the loft, I had the fair value of my old building, which is the selling price. I'm not selling it. I'm giving up the old building. So the fair value of my old building is 630,000. The book value is 750 that we 653,750 that we had calculated here. So I'm going to have a loss on the exchange of 23,750.
We're not seeing the Excel sheet.
You're not seeing the Excel sheet?
No.
Now are you?
Yeah.
Okay. So the loss is the same as when I sold it because I kept the fair value of the old building the same as the selling price. Okay. So the fair value of the old building was 630,000 and the book value was 653,000, the same amount that we had calculated here on our book value, the cost minus the accumulated depreciation. So I've got a $23,750 loss on the exchange. So I'm going to go back to the Word document. And so we see that we debit the loss on the exchange of the 23,750. Now, if I had a debit of 700,000, which we know where that came from, that's the fair value of the new asset, the debit of the 96,250, getting the accumulated depreciation from the old building out of the general ledger, record your loss, get the old building off, you would see that your journal entry would not balance by 70,000, that you would need a credit of 70,000 in order to get this journal entry to balance. What is that credit of 70,000 for? Why do I have cash of 70,000? Well, what was the fair value of the building that I received?
700,000.
Good, 700,000. So the person down the street gave me a building of 700 with a fair value of 700,000. What did I give them? A building.
650.
Good, 630. So is that a fair deal?
No.
No. How am I going to make it a fair deal?
Paying $70,000 to make it
Good.
equal fair value.
I have to pay the $70,000 in order to make it equal value. Good, Katone. What if it was the other way around? What if my building had a fair value of 700,000? Now I know that the gain or loss would change, but just thinking about the cash, what if the fair value of my building was 700,000 and the fair value of the asset that I received, what if it was the opposite, was 630?
Then you would get paid.
Right, so now I would debit cash for 70,000 because I would be the one receiving the cash. Okay, so this is how we record an exchange. This is an exchange with commercial substance. With commercial substance. Remember in chapter 6 that we talked about that in order for a revenue contract, a revenue recognition contract to be a valid contract, that it had to have commercial substance. How did we define commercial substance? There had to be expected future changes in expected future cash flows needed to be changed, right? That we expected future cash flows to change. So this would be an exchange with commercial substance. Exchanges with commercial substance, this was what was talked about in chapter 10, but I said we would talk about in chapter 11. Exchanges with commercial substance, you would recognize both a gain and a loss. So if the exchange has commercial substance, you would recognize the entire gain and the entire loss. We will finish the commercial, the rules on exchanges after we talk about this retirement. Retirement means that I just put it in the junk pile, gave up on it, threw it away. So Bostic decided to retire and just padlock up the loft, just abandon it. Now, we know in real life that she would sell an asset that had a fair value of 630,000, but Bostic just got tired and just padlocked it and abandoned the asset. So we would still record depreciation up to the date of sale. Now, what did we receive if we just abandoned it? Did I receive anything?
No.
No. So I just need to get the asset off the books, and the book value becomes my loss. What I got for my new asset is 0, minus your book value gives you your gain or loss. And the book value was 653,750. So that would be my loss on retirement. Okay. So that is how we record a loss. Retirement. Retirement. Retirement, can you ever have a gain on retirement? Can you ever have a gain on retirement? No, because you're either going to have, remember, your loss is the amount of your book value. Well, what if you had estimated that this asset had a residual value of 0, and you had fully depreciated the asset before you threw it in the junk pile? what would be the depreciation, what would be the book value of an asset that has been fully depreciated that has no residual value?
0.
0. So I got 0, the book value was 0. So all I would need to do is debit the building for $750,000 and credit accumulated depreciation for $750,000. Okay, because if I had fully depreciated, the cost and the accumulated depreciation would be the same number. So when you retire an asset, you can not have a gain. You're either going to have no loss if the book value is 0, or you're going to have a loss for the amount of the book value. Okay. There are a number of problems, end of chapter problems that you can practice. I will write another one similar to this where you have to do the sale, the exchange, and the retirement. Before we move on, in chapter 10, on the exchange, we said we would wait until we were dealing with exchanges to learn about the rules on exchanges. When we exchange an asset, look on page 531. When we exchange an asset, we have to determine whether it is with commercial substance or without commercial substance. One of the things that you should have noticed when we exchanged an asset was the new asset was put on the general ledger, on the balance sheet at its fair value. When I exchanged it, I acquired, through exchanging, an asset and the new fair value. So it would come on to the balance sheet at its fair value. Think about if I had a piece of property in Manhattan and I had purchased this property 75 years ago. A piece of property in Manhattan 75 years ago cost a whole lot less than it does today. A whole lot less than it does today. So this property that I had purchased in Manhattan would be on my balance sheet at what amount? Say I paid $50,000 for it, and today the fair value of it is $750,000. What would be in my general ledger? The $50,000 I paid for it, or the $750,000 that it's now valued at under US GAAP? Long-term assets are reported on the balance sheet at what? What do we
At
report
book
on the
value?
balance sheet? What do we report on the balance sheet?
Book value.
Good, good, Tanisha, book value. Okay, we'll report on the balance sheet book value. Book value is determined how?
Capitalized costs minus accumulated depreciation.
Okay, good. Cost minus accumulated depreciation. Was it fair value minus accumulated depreciation? Or cost minus accumulated depreciation? What did you just say, Katone?
I said cost.
Cost. So cost, long-term assets in US GAAP are reported under cost. Under cost. Okay? So when we exchange an asset, that piece of property in Manhattan would be on my balance sheet at 50,000. Now, would I say the fair value of it was? 750,000. Now, wouldn't you like to have 750,000 on your balance sheet as your asset instead of the 50,000? Don't you want more assets reported on your balance sheet? Well, under GAAP, we can't revalue. Under IFRS, we can. So what if I got into an exchange of property? Someone wanted that piece of land in Manhattan, and I decided that, I'm not familiar with, but I decided that I could build my corporate headquarters not in the city, okay, not in Manhattan, that I could build my headquarters in upstate New York, okay? So I get into an exchange of property with someone, with that person that wants my property in Manhattan, and it's valued at 750,000, and I acquire property. The fair value of the property that I'm going to exchange is 800,000. So I would give them my Manhattan property plus $50,000. And now my Manhattan property, or that land that I exchanged for, is on my balance sheet at what amount? The 50,000 or the 800,000?
800?
Good, the 800,000. Remember, we debited the building when we exchanged it at its fair value. So when I exchanged, it would be on the balance sheet at 850,000. Say that this was land, right? Just land. So what would the book value of it be? It cost 50,000. What would the book value of it be? Do we depreciate land?
No.
No. So what would be the book value? The 50,000, right? Because cost is 50,000. The accumulated depreciation is 0 because we don't depreciate land. And so it would have been on the balance sheet at 50,000. Okay. Now, say this had commercial substance. What would the amount of my gain be? I will share with you the Word document. Remember, this is my exchange right here. Okay. On this one, I had a loss on exchange of the 23,750. What would I have a gain or a loss on this particular asset? How did we calculate the loss of 23,750? What was the fair value of the old building?
630.
630, right? And the book value was, the book value was
750.
good, whatever that, no, the book value was,
653.
it was on the, good, that 653 number.
Oh, okay.
That's on the Excel, remember? And so it's 23,750 would have been the loss. Let me pull up that Excel sheet, and I know it's time for class. Remember the 630, the fair value of the old building minus the book value. Well, on this one, the fair value of the old building, I said was 750,000. And the book value was 50,000. So would I have a gain or a loss? All right, we'll pick this up on Thursday. I want y'all need to work some problems for us to get through this. I am going to upload, they would have, the bottom line is when they exchange this, I would now have an asset on my balance sheet of 800,000, and I would have a gain on my income statement of 700,000 just for exchanging property. If that property did not, if that exchange did not have commercial substance, GAAP says that the amount of gain that you can recognize is very, very limited. We will discuss the whys. I want you reading the whys on page 531. And I will also upload a problem like the one we just worked today with Bostic. So I will upload that problem. Please work it over between now and Thursday. Work the problem so that you understand disposals on selling them, exchanging them, and retiring them. Read about how we handle exchanges. If you look on page 534, there's a summary of how we handle exchanges with commercial substance and without commercial substance. All right, so can I have y'all a little more prepared and talkative on Thursday, our last day of class? Please, please. We're going to, I will put out a note of what we're going to have to cover, including we've got impairment that we need to cover. We need to cover it under US GAAP and under IFRS. Look on chapter 11 onto the topical coverage that I've uploaded for the exam. Look at what we're covering, what's included for chapter 11, and what we didn't discuss today, we're going to have to discuss on Thursday. Okay? Please be a little more prepared. Okay? See y'all on Thursday. Oh, and I do have office hours for, tomorrow. So, and I, again, look at what I have uploaded and will upload for practice for Thursday. All right. Peace out, sleepyheads.
Have a good one.
All righty. You do the same.
Bye-bye.
Bye-bye. Bye-bye.